Welcome back. Now, Hyprop has signaled improving momentum in the retail property sector, with distributable income rising nearly 13%, while distributable income per share increased 5.4% to just over 212 cents. Operationally, the country's biggest shopping mall landlord says stronger tenant sales, improved trading densities and declining vacancies across its South African malls helped underpin the performance, while its Eastern European portfolio continued to deliver stable growth. Company CEO Morné Wilken joins us now to unpack the numbers. Morné, thank you so much for your time today. Most of the key metrics in that result is moving in the right direction. And one thing that stood out for me was the adjustment to your payout ratio, moving to 82.5% for FY26 from 80%. What's driving that confidence? I know this is something the group has been considering for quite some time.
Thank you very much. Thank you for having me. The main reason for increasing our payout ratio was due to the fact that we have been working and sorting out our balance sheet over the last few years. So we have made very good progress in terms of that. We also have caught up with a lot of CapEx spend, and I think we are now in a position to actually increase that payout ratio. We have sorted out the balance sheet by reducing our LTV to about 31%. In Europe, we have reduced it to about 41%, and our interest cover ratio is 3 times. So I think it is a good position to go up in terms of payout ratio, but I must also caution, we will incrementally increase it, but it is also going to be a cap. I don't think we will ever go back to 100% payout ratio because it's quite key to look after your assets.
All right, so the balance sheet quite strong, gearing levels coming down as well. Let's talk about the operating environment. You're predominantly exposed to the retail property space, which has fared well. What trends are you seeing on the ground in terms of footfall, tenant demand and trading performance?
Trading metrics in South Africa is very good. Tenant turnover has increased by 5%. Trading density is up 7.5%. Footfall has increased by 1.9%. So that's all in all positive. In Europe, similarly, we had tenant turnover increasing by about 3.8% and our tenant turnover trading density by 3.6%. Footfall was a little bit down, but it's mainly due to the longer summer period we had. The summer holidays was longer than normal. Therefore, the foot count was down. But it was positive to see that the spend per head was quite up. So it means that the people are less frequently visiting, but they are spending a lot of money when they do go.
Okay, all right. Talk to me about the restructuring of the portfolio, particularly in South Africa, right? Not so long ago, the group was looking to sell a stake in Hyde Park Corner. That fell through. But recently, you announced the disposal of a 50% stake in Woodlands. What's the broader strategy guiding those moves?
I think we always look at our assets annually to see where we see recycle opportunities and where we want to keep the asset, where we can see more growth coming from it. If we take a Hyde Park in a point in case, that sale was structured in such a way where we wanted to extract more value from the asset because we know we were busy with a number of things. So the Hyde Park transaction was always structured with a true up after a 2-year period. Woodlands Boulevard we saw as a strategic sale where we sold 50% of the asset, but it was a consortium of 3 parties. Strategically, it ticked 3 boxes for us. It reduced our exposure in Gauteng. It gave us access to capital to redeploy in new and organic growth opportunities. And thirdly, we retained a majority stake in Woodlands Boulevard to participate as the surrounding area densifies and trading densities could improve.
Morné, I'm wondering if this move suggests that you see less value in Gauteng, or is it more about the Western Cape offering stronger growth prospects? I do know that the group is expanding Somerset Mall as well.
think to come back to your point, I mean, Gauteng, we saw more risks, I would say. If you look at what's happening in infrastructure and the state of repairs, it's not as good as the Western Cape, and therefore the Western Cape makes it more attractive for investment than Gauteng. What we have decided is to ensure our Gauteng assets operate properly. We have been doing a lot of work to improve the challenges from an infrastructure point of view, but it's costing a lot of money. I mean, we had to put in backup water at all our Gauteng sites, and that's costing you 4 to 5 million per site. So those challenges makes it very difficult to operate. Plus, you are paying money to a city improvement district like in Rosebank, and you're making the area better, and then your rates goes up, but you don't get a benefit back from the rates you are paying for.
And then I can imagine that then you'll be watching rather that local government election quite closely then.
Yeah, definitely. It's important for us to, so you can at least see service delivery in the areas you operate.
All right, quick one before I let you go. Turning to Europe, numbers looking strong. You gave us a bit of a summary of what's playing out on that front, but I'd like your outlook on there. You were quite bullish around acquisitions in that area. Is that still the case, or are you eyeing organic growth there?
No, there's opportunities for organic growth, but we're busy with a few potential transactions of new acquisitions, and that is high on our priority list to execute this financial year, and I would say the next.
All right, let's leave it there. Morné, thank you so much for your time and taking us through the 6 months that was for Hyprop. Now, that was Morné Wilken, CEO of Hyprop.